Hey everyone, hope you're having a great day. So this is going to be part one in a multi-part series on understanding stock movements. I wanted to kind of put this together on basically how I see the stock market, how I see different things happening in the stock market. I've seen a lot of chat on Discords and other places about individual stocks moving. I think there's like a lot of misconceptions out there around like what makes a stock move. So I just wanted to put this together and go over that. As always, I'm not a financial advisor. This is not financial advice. I don't have any type of formal training or education in finance or securities or anything like that. So this is just my opinion. That's about it. So take what you will from it, and let's dive on into it. So understanding stock movements, we're going to do part one is going to be about market makers. But before we get into market makers, I really want to kind of break down how I see the two kind of sections of market participants. And if we go into that, the two really market participants that I look at are market makers and market players. So that's how I kind of divvy them up in my head. So market makers are really there to, all they care about is providing liquidity. Their job, right, is to provide liquidity on the bid or the ask. The ask would be buying and the bid would be selling, right? So a market maker has a pretty tough job in that if they are making a market for a security, they have to buy and they have to sell, right? It's their job to buy and sell. They're not really taking one side of a long-term play in the security. They're just providing liquidity to it, right? So they're there to make sure that sellers always have somebody to sell to and buyers always have somebody to buy from. So that's pretty much, market makers are the main type of market maker. And then high frequency trading firms are kind of like market makers. When you get multiple market makers and a security is big enough to where it has multiple market makers and potentially HFT firms are looking for arbitrage opportunities within the market to be able to buy within the bid-ask spread and sell it to somebody within the bid-ask spread, and they're buying it at the lower end of the bid-ask spread and they're selling it at the higher end. They're looking for, like, literally they have basically fiber connectivity into some of these exchanges, and they're doing extremely high fast compute to find those arbitrage opportunities. So market players in my mind are market participants that they're taking more of a either short, medium, or long-term play on a stock, either to the upside or the downside. They have a directional bias. As soon as they buy, they have a directional bias, right? Or sell, they have a directional bias. Some market players could be investors, like long-term institutions, hedge funds, retail, or traders, short-term, medium-term prop firms, institutions, funds, and retail. So obviously the bigger the institution or the bigger the player, the bigger effect it can have on the market or a security. And when I talk about this, understanding stock movements, I'm really going to come from the perspective of a small cap company that has probably lower liquidity levels, and I'm thinking something that is on the smaller range, maybe $1 billion market cap or less. Something that's going to be trading either on the NASDAQ or maybe even the OTCs. So something that there isn't a ton of participation from maybe the overall market because it is a smaller security. And that's where I think information like this comes in the most useful, because it's exaggerated so much. The disconnects between fundamentals and the price can vary so drastically because of the lack of liquidity, the lack of bigger players being able to support the stock, and it just gives the market makers a better opportunity to really bring the stock up or down as they please. So let's get into it. Market makers. So a market maker is basically a company, an institution, a firm that their job is to create the market for that security, and they create the bid-ask spread, right? So usually when you look at a stock price, it's not really, the stock price isn't like, you know, 250. The stock price is actually, you know, the bid might be 240 and the ask might be 260, and 250 just happens to be the midpoint, right? So market makers are creating that bid-ask spread, and then they're basically providing liquidity and depth within the book, the L2 book. And you can kind of see this here. We see that there are tons of different exchanges, and there's going to be tons of different market makers that are looking at this security across these exchanges, looking for the depth of the book on the bid and the ask, try to gauge basically where is the most beneficial point on the bid and the ask for them to provide a market, as in they can sell on the bid and sell on the ask. They're getting paid essentially through exchange rebates for providing that liquidity, as well as they're getting paid by basically having arbitrage opportunity between buying on the bid and selling on the ask, right? So the result of this is, as we get more and more market makers into a security, market makers, institutions, HFTs, as we get more participation into a security, we get increased liquidity for both buyers and sellers. And it would be a really, really, really crappy place if we didn't have market makers. If we didn't have market makers that were basically didn't care about the stock, they care to a certain extent, and I'll get into that, but they're there to provide that ability for us to buy and sell at any time, okay? If we didn't have that, it could be a pain to buy or sell a security, right? It's like, it's pretty amazing that we can offload, you know, tens of thousands, potentially hundreds of thousands of dollars of securities into the market, and we can do that at any time because we have that liquidity, right? Now that affects what the market makers do next, and we'll get into that, but a stock market without market makers would be a horrible place because you would not have the absorption on the selling or the buying side as a seller or a buyer. It would be a very nasty place. So market makers, when it comes down to it, is they're always going to be looking at several things, but they have to balance the accumulation and the distribution of shares, right? They have to balance the buying and the selling. And ideally for a market maker, right, if they can just pin the bid and the ask and have a 20-cent spread and just continually, you know, sell and buy shares between that spread, that's going to be the ideal situation for them, because they're going to just be reaping the benefits of that spread the entire time. Stock price would pretty much stay, you know, either sell at, you know, 240 and buy at 260, and they would just be getting that spread over and over again. Super, super simplified example, but that is kind of the example I'm going to use here. Now, market makers will borrow and sell short a stock in order to provide liquidity. If you look at a market maker, they're kind of like an inventory manager, right? They're managing the inventory and the ability to provide that liquidity on the selling and the buying side. And I would encourage you guys just to like try to get into the mindset of like, if somebody was like, hey, you have to make a market for this, you've got like $1 million and so many thousand shares, good luck. You know, that's pretty scary, right? You have to buy and you have to sell. How would you structure that to where you come out ahead, or at least you don't get totally burned, right? It's pretty crazy. So a market maker will, in certain times, sell short a stock in order to provide liquidity to the buyers, okay? And I'll go through actually an example on Tenet right here in a second. Let's jump into that. All right, so this is also maybe a little bit of speculation on my part. So I'm not saying this is exactly what happened, but I think it's interesting that we kind of see this type of correlation when Tenet went through its last run. So we can see that short interest on Tenet, PKKFF, we're looking at fintel.io, where fintel.io compiles a lot of data from different reporters to gather the short interest and graph it out. So if we look at the short interest for Tenet, we can see it was kind of pretty much staying right around 400,000 shares, 500,000 shares for a pretty long time. And then come September, we started seeing this steady climb up. Now this data is only reported, I think, twice a month. So, but we can see that this short interest climbed from pretty much about 300,000 shares up to about 1.3 million. Towards around December, and then we started flooding back down. So at any given time, there's going to be short interest in a security. Like, that's just, it's going to happen. Now, whether that is market makers that are taking the stock short specifically to just provide selling liquidity on the ask, that can be debated. I mean, it gets so complicated when we get all of the market participants basically playing together in the security. It's hard to tell what exactly is going on. Obviously, we know that Tenet went through basically a short attack, not a short attack, but a short report, and then we can see that these shares just got unwound, right? So if we look at this and then jump over to the chart, if I can bring that up real quick. Jump over the chart, you can see that it doesn't totally correlate as far as time frame, as far as the short interest going up, but we do see an escalation in short interest as we pump into these extremely high ranges, right? And maybe that means that, you know, the market maker was able to provide liquidity into here, and then as it kept going higher and higher, they were out of inventory. I'm going to say inventory to supply shares on the ask. And had to take a stock short in order to supply the liquidity to the upside. Now, in my mind, what I see happen a lot is that we go through these events where volume spikes up a lot. And I'll pull up the volume here, actually. Here we go. So let's pull up the volume. We go through these events sometimes that whether it's market-based, fundamental-based, there's so many factors that play a role in it. But we go through these events where volume will spike up and we'll get this accumulation, and we'll see sustained volume as we accumulate. And, you know, this was kind of through the 2-to-1 split, through the NASDAQ uplisting, and then we got halted right here, and we opened up obviously down pretty far. So as the price is moving up, if the market makers do not have the inventory to supply the security to the buyers, they have to borrow that security and then basically sell it to provide the liquidity. What happens in that case is that the short interest on the stock, if it is being done by a market maker, is going to increase. And eventually, in my opinion, what I believe happens is that once that volume dies down, they're looking to unwind and essentially be able to buy back at lower areas. When volume dries up, it's easier for a market maker because, remember, they are in control essentially of the bid-ask spread. So it's easier for a market maker to take a stock down in a low volume because by that time the hype has worn off, all the buying demand has been absorbed, and now they can basically take it down fairly easily by just moving the bid-ask spread. Because what they'll do is they'll move the bid-ask spread. If they hit a point where demand comes in on the ask, then they'll move it back up, and then they'll move it back down. So they just range pretty much constantly. They're trying to absorb that liquidity. So I think it's interesting that we see kind of like this correlation, even though it's offset by a month or two. I think it's interesting that we see this correlation between the stock price and that that outstanding short graph that I showed later on. So I just want to show you guys that real quick and kind of give you my thoughts on that. I'm not saying that market makers were the ones shorting the stock, but it is definitely possible that if they ran out of inventory to supply shares on the ask, and they got in a bad situation, then they would have to take shares short in order to supply the stock on the run to the upside. So let's jump back over to the slide deck. All right, so going back to slide deck, really market makers, like, they will look at overall fundamentals to set target ranges, right? If you're supplying a market for a security or for goods or services or whatever that is, you're gonna look at what essentially the intrinsic, the value of that security would be in the market, right? So they're going to look at fundamentals compared to the market to try to find that basic area where it should be trading at. They will gap a stock up or down based on fundamental company catalysts, sector catalysts, and macro catalysts. So sometimes if a security is, releases really good earnings or something like that, or if we have a macro event and a war breaks out, like recent example, market makers will take that data into account. They'll try to assess it. They'll look at pre-market, they'll look at futures, they'll look at all these different things, and then they will try to see, okay, like, we're going to start the security out at this range, or we're going to try to move into this range. So that's when you get these gap ups or these gap downs. And then based on the demand and the price action after they gap it to that range, they'll move it accordingly, right? So it really all comes down to supply and demand with market maker, right? At the end of the day, a security could have the best fundamentals possible, or the worst possible, and the price action could vary greatly from the fundamentals, because the market makers are going to be concerned about being able to provide the liquidity. So if they're getting huge volume, they're going to move it down quicker than, like, if they're getting huge volume on the bid, they're going to move it down quicker until it kind of normalizes. And the same on the ask. If they're getting huge volume on the ask from a good catalyst, they're going to move it up until it kind of normalizes, right? Their target is to get it into these channels where they can consistently provide liquidity between that bid-ask spread and make that spread, right? And then get the rebates from the exchanges that they're participating with. So yeah, going on the next one, market makers obviously are going to look at overall stock market movements, sector movements, macro events. Kind of talked about that. Yeah, we kind of talked about this already. So, and then, like I said, when high/abnormal volume comes in, that's when they're most likely to move where they are making the market the most, right? If they're getting the huge amount of volume on the ask or on the bid, they're going to move that accordingly, because essentially they're going to want to get into a range where they can provide more of a stable environment within the bid-ask spread to create that market and provide that supply and demand. This is something we also kind of went over. You look at a lot of charts, and maybe we'll go over one here. We kind of did with Tenet, but you look at a lot of charts, and when volume starts stacking and you kind of see this just volume-based kind of slow rise into this euphoria, that's when a lot of market makers are having to absorb that liquidity, right? So they're constantly selling into it. They're bringing it up more and more. And as volume is higher and higher, they're going to bring up more and more. You get this kind of like parabolic moves. And sometimes this can happen in individual securities, can happen in sectors. It just depends. But once that volume normalizes, they're then in the position to where they can start offloading, bring the bid-ask spread down, bring it back into a more fundamental area of value for the security. So we kind of see these kind of like a blow off top, if you're familiar with that term, where you just go on this parabolic run, and then as the demand is over, the market makers aren't going to just leave the price up there if it's extended beyond fundamentals, and likewise they're not going to leave it super low if it's extended below fundamentals. Eventually, on the downside, eventually buying will come in that will bring it more in line. I believe market makers are probably more likely to leave it low because it reduces their risk as long as they can keep it low. They're trading the security at a lower price, so usually if they're trading that security at a lower price and they know that's a lower price from fundamentals, it's kind of an area for them to rebuild their inventory, right? To load back up on shares to provide the liquidity for the next run. So we can kind of get this movement of supplying to the buyers, and then potentially having to sell short to the buyers because they ran out of inventory, and then a regression back down to where they're able to accumulate back down, trading the bid-ask spread continuously until their short float is gone, and kind of repeat the process again. So the main thing that we have to look at really with market makers, that we have to understand with market makers, is that they have to provide liquidity to all market participants, right? They are there for making the market, especially if there are not a lot of traders and institutions that are doing more high frequency trading or very short duration trading. A market maker is the one providing the liquidity to almost the entire market. So, and that's going to be the case in a lot of small cap stocks, especially small cap stocks that aren't on major exchanges. As a security gets on more and more exchanges, additional market makers will start making markets in those securities. So when we onboard additional market makers, it usually provides for a tighter bid ask because there's more competition making the market, and it provides more liquidity within the market for the stock. So yeah, abnormal volume can drive short to medium time frame price disconnects from fundamentals as market makers absorb the volume on momentum runs or sell-offs. More market makers, greater liquidity and volume. And it can be frustrating, I guess, especially if you're in the position where you're taking the liquidity during those high volume runs, because that means you probably bought high and then you're riding it down low. And that can definitely be frustrating if you're in that position. But overall, big picture, I think what we have to take away from this is that, the market, the stock market, individual securities, how they trade, it's not efficient at all. Like, it's not like it is not efficient whatsoever when we track it back to the core fundamentals of the company, right? If it was efficient, instead of having a chart that just kind of went, low, really high, back low, really high, back low, really high, we would have a chart that was just kind of just steady going up. If the market was truly efficient, we would have way less volatility in a lot of small caps, right? Way less. They wouldn't go on crazy runs and they wouldn't go on crazy sell-offs. But what that does, it provides us opportunity to find those disconnects and to take advantage of them, but also to be aware of, maybe if a stock is running a little bit too hot, to hold off and wait for better deals that align more with the fundamentals, and also maybe the short-term technicals. So, and then high frequency traders, they're the only other real participant in the market that I know of that I would consider a market maker, because they are making a market. They're finding extremely fast, high-speed opportunities to trade between the bid and ask and take a little bit of the spread. Just a takeaway, you know, when I look at market movements and stock movements, I'm trying to get in the mindset of not just what the stock is doing, but I'm trying to get in the mindset of what all market participants are doing, right? It's one thing to look at a stock or look at a security and be like, oh, it went up, or oh, it's going down, or oh, what's this? It's a totally different thing to try to understand the underlying internal workings of the market, the different players in the market, what their objectives are, how they make money in the market. Because let's face it, anybody that's in the market wants to make money in the market. It's not like we're here to lose money, right? So I think when I can put my mindset towards an understanding of all market participants, it puts me in a better position to disconnect from the emotion of what the stock might be doing in order to have the patience and kind of the discernment of how I should manage my positions. So the next one that we're going to go over, I still haven't written it up or anything, but I do want to go over market players. And market players will be probably part 2. I'm guessing this is going to be a 3 or 4 part series, and I might do a questions answer section. If you have any questions, please leave a comment, or if you're in the Discord, hit me up in the Discord and throw the question there, and I'll try to go through all the questions after the 2 or 3 parts, and we can just have a good discussion on my thoughts of these different market participants, how they affect securities and they affect the stock market. And we can just kind of have an open-minded discussion, you know, try to not be biased, try to be clear-minded about what's going on. And hopefully if we do that, we can then, you know, make better decisions when we are looking at managing our positions in the market. You know, we can resist buying into fear, or resist buying into greed on FOMO, and we can distinguish when these huge price disconnects are happening and we have the best opportunities. So hope you guys enjoyed that. Look forward for the second part in this series over market players, and yeah, we'll catch you later.